In the current bull market, it seems like most stocks are heading in the right direction, yet clearly some gain more than others. So how can you find those best stocks before they explode higher? Today, I've got 3 high potential picks that rank in the top 5% of the thousands of stocks we analyze. They're all in different industries with different market caps and different growth profiles, but all share one thing in common: exceptional fundamentals the market hasn't fully priced in yet that points to impressive upside potential. For example, analysts forecast roughly 40% upside for stock number 2 in the coming year, and that may prove to be on the light side. So if you've been searching for potential winners before the rest of the market catches on, well, you're in the right place. Okay, quick intro. I'm Steve Reitmeister. I have over 40 years of investment experience analyzing the stock market. I spent many of those years as editor-in-chief at Zacks.com, sharing insights with millions of investors. And right now, I'm a partner at WallStreetZen.com, where I help build a quantitative system to allow investors like you to easily find quality stocks. And that matters because I'm not just sharing random stock picks today. I'm sharing you names where the fundamentals are screaming serious opportunity, the kind of setups that don't stay hidden for long. If you like videos like this one, then do me a favor and hit that like button down below. It helps me know what type of content you want to see more of in the future. Okay, our first stock today is Inhabit with the symbol of EHAB. Now, if you're not familiar with Inhabit, don't worry, because that's exactly the point today, and that's why it's on my stock list, because there's greater opportunity in underfollowed names. Inhabit operates in home health care and hospice care. Think of them as bringing hospital quality care directly into patients' homes. And here's why that matters right now. America is aging rapidly. Baby boomers are turning 65 at a rate of 10,000 per day. These patients need care, but they don't want to stay in expensive hospitals or nursing homes if they can avoid it. That's where Inhabit comes in. They provide skilled nursing, physical therapy, and hospice services right in the patient's home, which is not only what the patients prefer, but is also significantly more cost-effective. The company is experiencing increased demand for their medical care facilities, and its strategic initiatives expected to enhance profitability and operational efficiencies throughout the year ahead. Now, let's talk about the key fundamentals, because this is where Inhabit really shines. The Zen Ratings quant models gives EHAB an overall A rating, which is a strong buy, putting in the top 5% of the 4,600 stocks we track. But it gets even better. Looking at the component grades, which are the 7 key areas that really drive the long-term performance of a stock, EHAB also scores an exceptional A rating in growth. This means the company is delivering consistent growth across multiple measures, not just earnings, but revenue, cash flow, profit margins, and EBITDA. Now, it also scores a B rating in both safety and financial strength, which is impressive for a smaller healthcare company. That B in financials tells us the company is operationally sound with strong metrics across multiple profitability and balance sheet measures. Here's some important additional context. EHAB operates in the favorable medical care facility industry, which has a strong industry rating of A. And within that industry, Inhabit stands out as the number 3 highest rated stock out of the 42 companies we track in that industry, meaning right industry, right stock. Okay, EHAB only has 1 analyst rating right now, which is not surprisingly a strong buy. This is great news. Underfollowed companies like this one with strong fundamentals often get new Wall Street coverage that pumps up the stock price. Now, let me be transparent about the risk here, because no stock is perfect. First, this is a smaller company with a market cap under $600 million, higher volatility and less liquidity than large cap healthcare stocks. Second, Inhabit operates in a highly regulated industry, so any negative changes to Medicare reimbursement rates or healthcare policy could significantly impact revenue and profit margins. Third, the home healthcare industry is competitive and labor-intensive. If the company struggles to recruit and retain qualified nurses and therapists, it could limit its upside growth. And finally, there's no guarantee that current efficiency programs will continue to deliver the same positive results in the future. That said, the demographic tailwinds are undeniable. The aging of the population isn't slowing down, and the shift from institutional to home-based care is a multi-decade trend that's just getting started. When you combine those industry tailwinds with their exceptional A-rating growth, then you appreciate that Inhabit represents a compelling risk-reward for investors willing to handle some small-cap volatility. This is one of those under-the-radar opportunities in an attractive sector experiencing powerful long-term trends. quick pause here. If you're finding value in these picks and want to catch more timely setups before it's too late, then hit the subscribe and notification bell down below. I share new stock picks and market insights every week, helping you stay ahead of the crowd. All right, on to our second stock, and this one you probably heard of before, and then we're talking about Eli Lilly with a symbol of LLY. Most investors know Lilly for one thing, GLP-1, the weight loss drugs like Mounjaro and Zepbound. But the real story is much bigger here, and whether you care about obesity drugs or not, it's impossible to ignore what Lilly is becoming. That's being one of the most powerful and profitable drug companies over the next 10 to 20 years. Here's what really matters right now. GLP-1 drugs are changing modern medicine, and not just for obesity. We're talking about diabetes, heart disease risk, fatty liver disease, sleep apnea, and more. Right now, most GLP-1s are by injection, but Lilly is preparing something that could reshape the market again. I'm talking about Lilly's once-daily oral GLP-1 pill. No needles, no food or water restrictions, stronger results than Novo Nordisk's oral version. Analysts projecting over $10 billion in annual sales by the early 2030s. If injectables like Zepbound and Wegovy were phase 1 of the GLP boom, oral GLPs are phase 2, and Lilly is playing way ahead of the pack. This is why Lilly continues to outgrow nearly every other pharma stock, even though it already has a market cap of over $1.1 trillion. Let me put this in perspective. Lilly posted 120% earnings growth last year. That is not the kind of tame growth you would expect from an already large pharma company founded in the 1800s. And the GLP-1 franchise is only the beginning. The news cycle has been full of bullish developments for Lilly. The company recently announced an exciting partnership with Walmart, where patients can pick up Zepbound vials at Walmart for 50% off the list price through a program called Lilly Direct. Speaking of Lilly Direct, this is the company's direct-to-consumer platform that is expanding at a rapid pace. In fact, more than one-third of the new Zepbound prescriptions now come through Lilly Direct, bypassing traditional pharmacy benefit managers, pushing profit margins ever higher. All of this expands access, demand, and brand dominance, especially compared to Novo Nordisk, which has been slower to adopt direct-to-consumer distribution. But here's what many retail investors miss. Lilly isn't a one-drug company. The pipeline includes novel cancer therapeutics, immunology drugs, and new metabolic treatments beyond GLP-1. Lilly is already investing billions in new U.S. manufacturing hubs to keep up with the future demand, a rare sign of confidence about their future growth potential. Now let's talk about what Wall Street thinks. Right now, we follow 17 different analysts covering Lilly. It has 11 strong buy ratings, 3 buy ratings, and 3 holds. That 80% buy or better. But it gets even more impressive when you look at who is behind those recommendations. We've got strong buy ratings from several top-rated analysts based on their stock picking performance, including Mohit Bansal of Wells Fargo, who's in the top 15% of stock picking performance. Trung Yoon of UBS in the top 9%, Terrence Flynn of Morgan Stanley, top 6%, and Seamus Fernandez of Guggenheim, top analyst, all pounding the table on Lilly. And the current street high forecast suggests about 40% upside for shares in the coming year. When top-performing analysts like these cluster around a stock with this much conviction, you need to pay attention. The Zen ratings confirms what these analysts are seeing. That's because Lilly has earned an overall A or strong buy rating, putting in the top 5% of all stocks we track. Dialing into our component grades, it scores well across many of the key categories like growth, value, momentum, and our proprietary AI factor. It is also a standout for sentiment, which measures what the smart money thinks of the stock. That includes institutional money flows, Wall Street recommendations, earnings estimate revisions, and most importantly, insider buying. The only C for this stock is on safety, which if you look around is fairly normal for a pharma stock and reflects the regulatory and clinical trial risk inherent in the industry. Here's additional context. Lilly operates in the drug manufacturing industry, which is an industry rating of A overall. And within that industry, Lilly is currently the number 2 highest rated stock we track. Here again, meaning right industry, right stock. Now, let me be transparent about the risk, because even elite mega cap stocks like Lilly have risks you need to consider. First, Lilly's valuation has run up significantly with that massive $800 billion market cap and strong buy recent performance. There's less margin for error if growth disappoints or if the oral GLP-1 rollout faces any real setbacks. Second, competition is intensifying. Multiple pharmaceutical companies are developing competing GLP-1 drugs and alternative obesity treatments. This could eat away at Lilly's lead. Third, regulatory risk is always present in pharma. Any safety concerns, manufacturing issues, FDA delays with their oral GLP-1 pill, or anything else in the pipeline of drugs could impact their growth trajectory. And finally, political risk. Drug pricing remains a hot political topic. While Lilly has been proactive with programs like Lilly Direct and with Walmart, any major legislative changes around drug pricing could all obviously affect their profitability. That said, here's the most compelling counterargument. The demographic trends are undeniable. Over 40% of American adults are obese, and the health consequences are staggering. The market for effective weight loss treatments is enormous and just getting started. Lilly's lead in the space, combined with its deep pipeline, rising margins, direct-to-consumer strategy, and smart partnerships, positions it as one of the cleanest long-term leaders in healthcare. In a sector dealing with political pressure and pricing concerns, Lilly stands out as an A-rated name in an A-rated industry with a growth runway most pharma companies would kill for. This is the rare mega cap that still has the growth profile of a much smaller company. And despite the risk I just outlined, that combination of market leadership, innovation, and execution makes Lilly's shares very compelling at current levels. Before I move on to stock number 3, I wanted to share something with you. I use the same Zen rating system to find more high-potential stocks I believe could easily double in the year ahead. You can get these stocks for free either by scanning the QR code or by clicking the link in the description. All right, let's move on to that third and final stock. I'm talking about IBEX Limited with a symbol of IBEX. It's my favorite pick of the bunch and a recent stock of the week selection. By the way, if you want to get my stock of the week in the future, then just subscribe to our free newsletter. You'll find the link in the description below. IBEX operates a customer lifestyle experience platform, which is a fancy way of saying they have a myriad of technology solutions to help companies handle customer service and increase satisfaction. The reality is that a small cap stock like this, with a market cap of just over $500 million, is that there is very little information to help you with research. They're not covered heavily by the mainstream financial media or Wall Street analysts. The upside is that our well-rounded 115-factor Zen ratings AI-driven quant model tracks down the most fundamentally attractive stocks with the most upside potential. And here's the kicker. IBEX isn't just an A-rated stock overall. It's actually ranks in the top 1% of all 4,600 stocks our system analyzes. When you see a ranking this high, you pay serious attention. Now, let me explain a little bit more about what IBEX actually does because it gives it important context. Think of IBEX as the behind-the-scenes technology powering elite customer engagement for companies around the world. They build powerful customer service and insight solutions, everything from call centers to digital engagement platforms. Their clients include startups, scale-ups, and blue-chip companies who need best-in-class customer experience outsourcing. Here's why this matters right now. IBEX just reported record-breaking fiscal 2026 results and raised full-year guidance. Even better, this was their fourth consecutive earnings beat, while the average beat over that stretch was a whopping 33% above expectations. That's the kind of earnings momentum is rare, which is what greatly attracts me to these shares. And there are two big reasons why IBEX aligns so well with my 2026 investment strategy. First, size matters. Market valuation metrics are very clear right now. Large caps on average are overpriced, while small caps have the most upside potential. We've already seen a rotation happening this year, and IBEX is positioned perfectly to benefit from this continuing trend. Second, IBEX has that strong Zen ratings profile I already mentioned, not just an A rating, but the top 1% status reviewed by our AI-driven model. Looking at the component grades, IBEX scores exceptional A ratings in both value and financials. That A for value means that it is more attractively priced than 95% of available stocks, whereas the A for financials tells us the company is exceptionally well run with impressionable operational metrics. This is a leading indicator of more earnings beats likely on the way. IBEX also scores a B in sentiment, which indicates the smart money is already starting to take note of this special opportunity, meaning that this currently under-the-radar pick may not stay hidden for much longer. And just for good measure, let me note that IBEX is the number one rated stock in the growing information technology service industry. Now, let me be transparent about the risk because small caps like this come with unique considerations. First, there's liquidity. With a $513 million market cap, IBEX has less liquidity than large cap stocks. This means wider bid-ask spreads and potentially more volatility. That's great on the up days, but a bit rough on the down days. Second, the customer experience outsourcing industry is a competitive space. The larger players like Concentrix, Teleperformance, and others compete for the same clients. If IBEX's offerings don't keep pace, they could lose customers or face pricing pressure that would significantly impact results. Third, as a smaller company, IBEX has less financial cushion than larger companies. If industry conditions slow, IBEX could feel that impact more acutely than some of their larger peers. That said, here's the bullish counter argument, and it's quite compelling. IBEX's consistency speaks volumes. 4 consecutive earnings beats, 33% average beat, record-breaking performance, raised guidance for the future. This isn't a company struggling to execute. This is a company firing on all cylinders. The fact that it's the number 1 rated stock in its industry and ranks in the top 1% overall tells us the fundamentals are overwhelmingly positive across our thorough review of 115 different factors. And those exceptional A ratings in value and financials, that is a rare combination. You don't often find a company that's both attractively priced and so excellent at operational efficiency. The small cap nature of the stock actually works in our favor. The institutional money hasn't fully piled in and analyst coverage is light, meaning it is still flying under the radar but won't last forever. As IBEX continues to deliver each earnings season, more investors will discover the story, more analysts will initiate coverage, and that's when the price should really take off. At current levels, IBEX represents a compelling risk-reward for investors willing to handle some of that small cap volatility. This stock has the look of a potential double over the next 1 to 2 years, especially if they keep executing at this very, very high level. So there you have it, 3 super attractive strong buy stocks that are still flying under the radar. Inhabit, the home health and hospice play, benefiting from powerful demographic tailwinds of an aging population with an exceptional A rating for growth. Eli Lilly, the pharmaceutical giant dominating the GLP-1 revolution, with an oral drug that could unlock a massive new market and backed by top-tier Wall Street analysts. And finally, IBEX Limited, a top 1% rated stock that also ranks number 1 in the information technology services industry with consistent execution, exceptional fundamentals, and meaningful upside potential. Okay, 3 different companies, 3 different price points, 3 different risk profiles, but one common thread: strong fundamentals and meaningful upside potential. Remember, these are all A ratings from our Zen ratings model, which historically identifies stocks that deliver over 32% average annual gains. That's not a guarantee, as past performance never is, but it significantly improves your odds of finding winners before the rest of the market catches on. Now, please drop a comment below and tell me which of these 3 stocks interest you the most. And if you want more exciting opportunities like these, we send out a free email every Sunday featuring our top stock picks for the week ahead. Plus, I send out a Stock of the Week email every Monday. You can get all that by following the link in the description below. And in case you're curious how I found these stocks, they all came from the wide range of data and tools on WallStreetZen.com. This includes our proprietary Zen ratings model, a 115-factor fundamental review powered by AI that analyzes over 4,600 stocks on a daily basis. You can get the Zen ratings for free on all these stocks at WallStreetZen.com. Just enter any ticker to see their vital ratings on our quote pages. By the way, these aren't the only stocks poised to benefit in the near term. If you're interested in vastly undervalued stocks with immense upside potential, I highly recommend you check out this next video featuring what might be the 3 most undervalued stocks to buy in the year ahead.